There's a huge problem with the S&P 500 that could cost you a lot of money and stop you buying it, and worst of all, you may not even know that it's happening. This video is brought to you by CoinJar, but more on that later. To understand exactly what the problem is, we need to understand exactly where this issue comes from. The S&P 500, or by its full title, the Standard & Poor's 500 Index, is a market capitalization weighted index of the 500 leading publicly traded companies in America. It's not an exact list of the top 500 companies because there's other criteria the index includes, but it's still regarded as one of the biggest gauges of US equities performance and, by extension, the performance of the overall stock market. People often regard the S&P 500 as being its own entity, but take away the index funds and the ETFs, and in reality, all it is a list of 500 companies. But the issue I'm talking about today doesn't just apply to the 500 companies here, it actually applies to the 2,918 companies on the US stock exchange. This problem is going to apply to any companies that you own shares of that are based in the USA. To get a better understanding of this, I need to take a look at myself in the mirror. No, not Chris now, Chris in 2007. It's 2007 and 17-year-old Chris is off on his summer holiday to his favourite place in the world, Disneyland. Okay, let's call it Universal Studios to make me look a bit more cool. He'd spend his days exploring the parks, and after a long day of riding his favourite rides, his family head back to their private villa, which had his very own pool. And later they would head out for a delicious fillet steak every night. And what was the best thing about it? It was all 50% off. Well, technically it was free because my parents paid for the majority of it, but why? Because in 2007, £1 equaled a whopping $2. Those were the days. Fast forward 15 years and 32-year-old Chris dreams of his dream vacation. A classic road trip through Route 66 in his Chevy Impala with his brother Sam, hunting demons along the way. And what stops this beautiful dream becoming a reality? The dreaded exchange rate. Yep, that's right. As of today, £1 will get you a whopping $1.16. That must be the euro exchange rate, right? Unfortunately not. This means that a $5,000 trip would have cost me £2,500, would now cost me a whopping $4,292. Yikes.
Right! I know! Yikes!
See where I'm going with this? If not, you're probably thinking, I'm not going on American vacation, this doesn't apply to me. Well, this, like my US vacation, my burgers, fries, and daily Chipotles, anything that you buy from the US, you are going to pay that dreaded exchange rate. And this goes for US stocks too. Investing internationally can bring a lot of advantages to a portfolio, but it also exposes you to a thing called exchange rate risk. Instead of investing in British shares, which is simple and straightforward, you buy in pounds and you sell in pounds, you are buying shares in a foreign currency, which in this case need to be bought in dollars. Now, this can make you pretty confused because you might not end up with the same return from a stock like Tesla as someone who's American. Equally, an American might not get the same returns by investing in a British company like Barclays. To understand exactly why this happened, let's turn to our trusty friend, Vanguard. Here's what Vanguard have to say about foreign exchange. At Vanguard, currency fluctuations don't apply to our global bond investments, since the primary role of bonds in an investment portfolio is, in our view, to act as stabilizers. We always hedge these into an investor's home currency to isolate these qualities and minimize the potential volatility of the asset. Shares, though, are inherently more volatile than bonds. They are there to drive returns, so investing in them means you're comfortable with some higher risk. As such, it's more normal for share investments to be left unhedged. Also, for some currencies, hedging currency risk in equities can actually lead to higher levels of portfolio volatility. Now, what I'm about to show you may surprise you and might not be something you've expected when we look at a flat 10% return for the S&P 500. Here's the return for the S&P 500 over the last 6 years, recorded by Vanguard. You can see in 2016, the return in USD was 12%, whereas the return in pounds was 33.6%, noticeably the biggest difference on this chart. Whereas in 2019, 31.5% and 26.4%, you can see the numbers are much closer. Of course, this depends on the year and what the current exchange rate is. Sometimes this will work in our favour and other times it will work against us. So when you buy a share or a fund, here's what's happening. You deposit pounds into your investment account. Your pounds are then converted into USD at the current exchange rate. Your shares of the S&P 500 are then purchased with your dollars. When you decide to sell, your stocks are sold for dollars. Then finally, your dollars are converted back to pounds. Now, of course, this is all good and well when the exchange rate stays the same, but what happens when it doesn't? Well, if the dollar gets stronger, here's what happens. Let's use £100 as it's an easy number. Your £100 is converted to dollars with an exchange rate of $1.40 to the pound. So you receive your $140. Simple. Now, over time, the dollar gets stronger and the new exchange rate is $1.30 to the pound. And then you sell, converting your $140 to pounds, and you receive £108. Woohoo, you've just profited £8. Congratulations. But that's not the problem. The problem comes when the dollar gets weaker. In this example, you invest your £100 in the same way, but this time the exchange rate is $1.30 to the pound. You receive $130, and then over time, the USD weakens and the new rate is $1.40 to the pound. This time, when you exchange your $130 back, you are left with £93, and you've lost out on £7. Ouch. Actually, it's even worse when you look at it at a 7% loss. Now, this is where it gets tricky, because essentially you're trying to work out, is the dollar strong? And yes, it is. As we can see through 2022, the dollar has actually just gotten stronger and stronger. In times of turmoil, the dollar tends to do well because people think it's a safe investment. I'm sure a lot of crypto investors who will have been burned will be piling their money back into the good old dollar. The dollar, however, has not beaten every currency this year. The rise in energy and food prices, which accelerated after Russia's invasion of Ukraine, has been a boom for the currencies of countries like Angola, a major oil producer, Uruguay, a major food exporter, and Brazil, which sells a lot of energy and agricultural commodities. The Russian ruble, surprisingly, has been one of the best performing currencies against the dollar this year. There's been high oil and gas prices, as well as capital controls imposed by Russia to keep money inside the country, have propped up the official exchange rate. Now, whether they can actually buy dollars is a whole other video. The US economy is looking shakier, but as Europe faces an energy crisis, Japan resists raising interest rates, and China's COVID-19 lockdown policies hurt its supply chains, plus other countries are under the weight of high inflation, demand for the dollar looks robust, though it remains unclear just for how long. A Goldman Sachs analysis said, for now, we still expect the dollar to trade on the front foot. There might be a bit more to go, but probably the largest part of the dollar move may be well behind us. We're also going through a rough time here in the UK, with other factors not helping, like the risk of Scottish independence and the disputes over post-Brexit trading agreements for Northern Ireland. The main takeaway here is that the dollar is strong, and it's likely to stay strong for quite a while in my opinion. But then it may get weaker as the UK gets through the worst of these next few years. But although the dollar looks really strong, we have to also realise that the pound is not doing well. I have to say a huge thank you to today's sponsor, CoinJar. CoinJar make it simple, safe and easy to buy crypto in one place with industry-leading security. They have an easy to use app, a free debit card you can use to spend crypto, and they reward you in points for every transaction that you make. If you aren't sure which cryptocurrencies to buy, they have these handy bundles that you can buy regularly and set and forget. They're the only app that I currently use to buy crypto, so if you're worried about cryptocurrency, they're definitely the app that I would recommend, and I'll leave a link to them down below because you can grab your free card. Okay, so now you understand the problem with the S&P 500, what can you do about it? Well, first, it's important to know the dollar actually fluctuates more than you think. Here's how the dollar has fluctuated since 1986. It's been up, down, up, down, up, down, but actually it's pretty much leveled out. The second thing to note is because the currency swings both ways, then so can your returns. In fact, if you look at the return of £1,000 invested in the S&P 500 since 2013, you can see that in pounds, it's actually performed better. In 2017, you can see that the rate actually worked against UK investors, but overall you would have been better off. In fact, 16% better off. This is because the US dollar has gotten stronger over this period of time. Now, that may continue, but you have to be aware of when it doesn't. The real question is, will the dollar continue to strengthen, or could we see the reverse happen in the next 15 years? If you're a long-term investor, then this isn't as important, because as we can see, over time it does average out. The problem is it depends on the market conditions and what will do better. If we believe that UK companies will be stronger with their hefty dividends, the simple answer is to just invest in the UK. The problem, however, is we can't deny that the US has the growth stocks which have driven these insane returns over the last 5 to 10 years. The answer's either you don't care, it'll work itself out, or perhaps the smarter approach is to realise that now is a good time, if you haven't already, to take this time to be a little more hesitant. Explore some undervalued UK companies and make sure you've got those cash positions on hand. My pension is now at over 50% cash. The main thing you need to watch out for though is if you're buying US shares listed on the US stock exchange and you're paying in dollars, be aware with the current exchange rate, it ain't cheap.
I'm expensive.
Something people often don't mention is there is an advantage of owning shares in your own currency, and this just demonstrates how important that actually can be. Of course, if you're not using an ISA, you could use something like stake, and when you buy and sell, it keeps all of your money in dollars. But then you do face the same problem that at some point you still have to sell, so you could find yourself waiting forever for the right moment in time. We have had the luxury over a long period of time of just ignoring the exchange rate, but now when it's so close, I think we need to be a bit smarter. If you want to see exactly how I'm doing and what I'm buying, check out this video right here, as I'll have my next update coming very shortly. Thanks for watching, and I'll see you guys in the next video.